Welcome back to Boni's Life, your home for in-depth trading education. In our last episode, we laid the foundation by exploring moving averages. Today, we're building on that knowledge by diving into one of the most popular momentum indicators, the Relative Strength Index, or RSI. The RSI is a powerful tool that helps traders gauge the speed and change of price movements. It was developed by J. Wells Wilder Jr. and is an oscillator that moves between 0 and 100. The RSI helps us identify overbought and oversold conditions in a market, which can signal potential reversals or pullbacks. But as we'll see, the RSI is much more than just an overbought, oversold indicator. So, how does the RSI work? It compares the magnitude of recent gains to recent losses over a specified time period, typically 14 periods. The result is a number that ranges from 0 to 100. A reading above 70 is generally considered to be in the overbought territory, suggesting that the asset may be due for a pullback. A reading below 30 is considered oversold, suggesting that the asset may be due for a bounce. One of the most powerful signals that the RSI can provide is divergence. Divergence occurs when the price of an asset is moving in the opposite direction of the RSI. There are two types of divergence, bullish and bearish. The RSI can also be used to confirm a trend. In a strong uptrend, the RSI will tend to stay in the 40 to 90 range, with the 40 to 50 zone acting as support. In a strong downtrend, the RSI will tend to stay in the 10 to 60 range, with the 50 to 60 zone acting as resistance. If the RSI starts to move outside of these ranges, it could be an early sign that the trend is weakening. To get the most out of the RSI, it's best to use it in combination with other indicators. For example, you could use a moving average to identify the overall trend, and then use the RSI to pinpoint entry and exit points. If the price is above a long-term moving average, you would only look for bullish signals from the RSI, such as a bounce from oversold territory or a bullish divergence. This helps to filter out false signals and trade in the direction of the dominant trend. In summary, the Relative Strength Index is a versatile momentum indicator that can provide valuable insights into market dynamics. It helps to identify overbought and oversold conditions, spot potential trend reversals through divergence, and confirm the strength of a trend. By understanding how to use the RSI in different market conditions and in combination with other tools, you can significantly enhance your trading strategy. That's it for this episode on the RSI. I hope you're starting to see how these indicators can be layered together to build a robust trading system. In our next episode, we'll be exploring the MACD, or Moving Average Convergence Divergence. It's another powerful momentum indicator that you won't want to miss. Make sure to subscribe and hit the notification bell. Until next time, stay disciplined and trade with confidence.